Welcome to the Broken Pie Chart Podcast, episode 364. I'm your host, Derek Moore. With me is Mike Snyder. Shane is off this week. All right, Mike, we got some CPI data, and year over year, if I look at the core, 2.5%. And if we look at the chart on core CPI, it has been down to flat, going back to 2022. Where it sort of crested. And then you look within the numbers, and really the thing that's holding it up is shelter. And shelter makes up about 44.25% of the core CPI. So core is X food, X energy. And services make up about 75% of core CPI. So then you start to look and you look through some of these numbers, and you're like, okay, so what is really going on here? Well, it's shelter. Shelter is up 1.33%. And then within services, there's some other stuff that's up, but a lot of the stuff is down. Goods is, I think for the month, was basically flat. And so I think my takeaway from this is that we are not seeing inflation. We're not seeing the rate of change in inflation move higher. We are not seeing tariffs impact inflation. And you might say, well, but for tariffs, would we be at 1.8% year over year? You can't really prove that. But goods is where I would think you'd see a lot of the impact there. What's interesting too is if you watch like the regular nightly news, and I don't even know who does that anymore, but let's say you did, you would hear about, well, prices are still really, really high. And yeah, of course, because prices don't really go down. And I think what people continue to misunderstand about inflation is inflation slowing doesn't mean prices go down. It just means the rate of change, either on a month-to-month or a year-over-year basis, does go down. I'll throw a couple other nuggets at you, Mike, and then we can kind of get into this a little bit. I saw that eggs are down year over year. Let me see, 34.2%. They were down 7% December to January. And then I look at instant coffee is up 26% year over year. So eggs down, coffee up. I'm looking through some other nuggets here. Tomatoes down 2.4%. I don't know why I picked tomatoes. I'm looking for other big numbers here. Energy. So energy commodities, fuel oil, those types of things are down 6-7% year over year. And then you kind of go through non-electric cookware and tableware, Mike. I know you were anxiously awaiting those numbers, up 13.1% year over year. I'm seeing if anything else is really down. Audio equipment is up 13.5%. Airline tickets are up a lot, but smartphones are down 10.5%. So moving, storage, and freight expense is down 15%. Okay, I'll stop there. This is getting ridiculous. But I think the takeaway is, yeah, there's no issue with inflation.
Yeah, if you're in the camp of wanting lower rates, this is an encouraging number. Like you said, shelter sort of holding up inflation this month, being the component that was up the most. And I think it's important what you said earlier that, prices generally don't come down. So everything feels expensive, but that doesn't mean that it's getting more expensive on a month over month basis. Or the change in that rate of prices is increasing, right? We're not seeing the rate of prices go up at the same pace we were. So there was a big jump in prices of general goods, a few years ago, and that we're still feeling that. I think that's sort of when people go to the grocery store and say everything's so expensive. I think that's what people are still feeling. It's not that the prices are continuing to grow at that rate. It's just that they're still at those levels, and they're probably not gonna come down, right?
No, I mean, that's just not how it works. They don't come down. They really don't. And I guess the other thing too about shelter is it tends to be lagging. And we saw this in 21, 22, remember when home prices really shot up and rents shot up. And it took a while to see that in the numbers, even though everyone knew it was happening. Rents on a year-over-year basis through the end of December, looking at the Zillow new rents index, I think it was only 2% year over year. So, if you look at Zillow, which is more what's it doing right now, you would say that, okay, well, at some point, shelter should come down more, depending upon, what we see. I'm just looking through the numbers too. I mean, food really isn't, it's up 0.39% year over year. Energy is, as a whole, is sort of, down. But of course that's not in the core. So, but Mike, it goes back to interest rates. And if I look at the interest rate picture and the Fed funds futures and things like that, it's still saying the 100% probability we have a cut at the July 29th meeting. It's about 86% we'd have one in June. Remember, Powell is supposed to be, they will have replaced him as chair. His term, I believe, ends in May. In theory, he could stay on and prevent somebody else being appointed to the board. But then a second cut is not 100% guaranteed. I shouldn't say guaranteed. 100% probability based on where the Fed funds futures are until really October. You could make the argument maybe the September meeting, October. I don't know. I don't know if I agree with this. I think if I look at this data and I say the rate of change isn't increasing, shelter is more of a lagging thing, and then you look at employment had a beat, number of jobs created, but there really isn't inflation. And I go back to the whole idea of for a decade we had near zero rates and we didn't have inflation. I feel like, this is just my opinion, the market is underpricing how many cuts we'll have through the end of the year.
The market is underpricing how many cuts.
That's what I think.
Okay.
Do you disagree? Or is it 2? Is 2 the right number?
I'm at 2 for the moment. I think if we get more numbers like this, I think I would start leaning towards 3. Right now, what is it? It's by December 2.5 is what they're pricing in. So it's right in between there, not pricing in 3, but saying there's a chance. So I think right now I would be in the 2 camp. I think 1 month is, of a number like this is encouraging if you want lower rates. I don't know that it confirms a trend, although, the rate has been steady the last few months. So.
All right. I don't know why rates have to remain this high. I don't think then again, it doesn't really matter. It doesn't really matter if you go from right now, the target rate's about 3.75, the band is, 3.50, 3.75, the effective rate's 3.64%. Let's say we get 2 cuts or we get, a little bit more cut. Going down to 3, if we had 50 basis points, you figure, we're somewhere like a 3.10 effective Fed funds rate. If you just take 50 basis points off the effective now. Does that move the needle? Housing, maybe.
Maybe, yeah.
Maybe that's helpful. And I think you saw that today. If you look at VNQ, which is the real estate ETF from Vanguard, last couple days and then today you saw that run up. Lower rates would help real estate. I think, that's why you see and I will tell you that REITs and real estate ETFs, they have not, they've been kind of flat to down for a while. So, and I think, maybe that goes to the bigger picture of we're seeing this rotation within a rotation. So today we saw rates down, bonds up, real estate did pretty well. But then you look at the rotation out of some of the bigger techie names. Exxon, Pepsi, Lockheed Martin. I'm trying to remember some of the other ones. It's more like a value. Is this a switch to value now? Is value finally? The value asset managers have been telling us for 2 decades, value is going to come back at some point. Like, is it going to come back now?
Yeah. So, I mean, this week, 6 sectors: industrials, energy, utilities, materials, consumer staples, real estate, all hit 52-week highs. We still have pretty much a flat market on the year. So there's certainly been a rotation. The S&P equal weight now on a 1-year basis has outperformed the S&P market weight. So everyone talking about the concentration in the S&P and needing the market to broaden out, it's broadened out for sure. We have Exxon, like a stock like Exxon, like you said, I think it's up 25% plus year to date. Yet the market's flat. So what I'm wondering is, can this rally continue or start again without the participation of tech and the Mag 7? Because we've seen now 6 sectors not related to tech hit 52-week highs, yet the market is still flat. So it's almost like this broadening is keeping the market from selling off rather than really driving it higher.
I mean, don't you think you just sort of need some of the big names? You need Nvidia, Apple, although we should talk about Apple. Apple finally, the last 2 days, kind of came back. What we don't want is these stocks to get really materially lower. Although you could argue Microsoft is in a bear market. Apple last 2 days, I mean, it hit what? Above 280, and now it's, where did it close today? 258 and change? So, and that was on the news. I think, if I read that on Bloomberg, the U.S. federal government sent a letter talking about them prioritizing left-leaning news over right-leaning news. And they sent a letter. I don't know if it was an antitrust thing or if it was there was something. And that was really, there was nothing else that I saw from Apple that explained the price, although it's run up a lot. So I don't know.
Amazon's down over 15% in the last 10 days.
Yeah.
I mean, it's on one hand sort of impressive that the market has been resilient with large names either doing nothing or selling off. Nvidia flat for the year. On the other hand, I'm starting to wonder, where does the market go from here if these names aren't going to drive it higher after we've seen the run up in some of the other names?
Okay, well, let's look at what's right below the top 10. So if we take out, so you got to take out kind of Berkshire, right? Because Berkshire holds a lot of the stuff that's in the Dow anyway. So you kind of take them out. So you take out Berkshire. You take out one of the alphabets, one of the Googles, and I do that. And then you say, okay, well, JP Morgan's number 10 right now. And then below the top 10, I mean, just for the audience, Nvidia, Apple, Microsoft, Google, Amazon, did I say them already? Broadcom, Meta, Tesla, and JP Morgan. That's your top 10. And then Exxon's come out of nowhere. Exxon's 12th now. Eli Lilly's 11th. 13th is Johnson & Johnson, Walmart, Visa, Micron. Micron's been on an unbelievable run. Like Micron, I remember trading that in the mid-90s. Yeah, it was probably the mid-90s trading that, when that was one of those growthy stocks. Costco, MasterCard, AbbVie, Home Depot. That's the next 10. So where's it going to come from? It's names like that. And then you go beyond those and you get into, Chevron, Bank of America, Caterpillar, I won't name all these. Coca-Cola, it's the drug stocks. It's some financials, energy. It's not tech. But you could say, I think one of the tells will be, can some of these companies surge into the top 10? And it's not necessarily because one of the top 10 has really been cut off at the knees, right?
Yeah, that's what needs to happen. I think if we're going to see the top 10 be flat or down like we've seen for the most part, you're going to need to see Exxon, Walmart, Visa, Costco, some of these names jump into the top 10.
Yeah.
If you're looking at a market that's going higher without the top 10 names. That's what you need to see. You need to see a complete rotation. I wonder if that can happen. We've already seen Exxon go up. It's 23% year to date. I mean, how much more? Of course, it can continue to run, but that's already a pretty big move.
It's kind of a big move, and sometimes they go up and they come back. Oracle is now, I think, 37th or 36th in. Oh, you know what? Eli Lilly is in the top 10. I should tell. I have my first line in my spreadsheet says name and ticker, and I just realized I was counting that as one of them. So, but Oracle is 36th. Didn't they break into the top 10 for a split second when they went on that unbelievable run?
They did. Yeah. Back in September, I think, after earnings, it jumped and is now below where it was prior to that. So,
like, if you look at the market cap of Exxon, like if we said, what's the market cap of Exxon? What's the market cap of Oracle? So I look at Oracle and I say, all right, I just want to know what the market cap is. Oracle today, let me see, 460 billion. And then you look at Exxon. So think about this for a second. And you look at Exxon, what did we say? 460 billion for them. Let me just go to the page that I go to. Yeah, 626 billion. So now put Exxon at another price, at its price before it went up, and you look at what Oracle was before it went down, and those two were flipped. This is one, like, it's possible it happens. You make a good point, though. I mean, it's not like Exxon is doing stuff that Nvidia is doing, and you think about how much more growth is going to happen on Exxon. Exxon's really a story of access to product and input cost to me. So
that's sort of what I'm getting at. Like, where's the innovation that's going to, grow their earnings beyond operating margins? And maybe there is, and I'm missing it. But that's what I'm getting at. I mean, it's not like if you look at, some of these companies, Exxon's trading at a 20 forward PE. It's not like it's crazy expensive, but no. I think it's, trading at a 20 PE because, where does that earnings growth come from?
Okay, so that's trading at you said a 20 forward PE?
That's what I'm showing.
Okay, fair enough. So then let me look at Nvidia. And if I look at Nvidia, now I'm curious what their forward PE is based upon the earnings. And this will kind of tell you a little bit about what's happened below the surface in the market. So let me just do this blind. Yeah, I mean, Nvidia next 12 months, 25.96. So 25 point, let's round it, 26 forward PE versus Exxon at 20.
Right.
Now, that seems closer than it is. Those 6 additional points matter when, you're thinking about on an annual basis what the next 12 months forward estimate is. But it's not like Nvidia is 45 and Exxon is 10. They're closer than they were. So
yeah. So, I mean, does that tell you that Nvidia has room for, multiple expansion because it seems cheap, or is it cheap for a reason? No one knows, obviously, but
I think the multiples have re-rated. I mean, the multiples have compressed, especially in tech, because earnings estimates are not going down for tech.
Right.
At least, Nvidia and some of the big ones. So, I mean, Apple was that just a multiple compression story? Like, did anything materially change with this letter from, I guess it was the Justice Department. No, actually it was the FTC, Federal Trade Commission. But Apple's almost 30 times next 12 months forward. So, I mean, this is nothing really material has changed with the earnings estimates. It's just the multiples come down.
Yeah, I think this was a fear coming into this year. The earnings story seemed very solid, but the market can go down when earnings continue to grow, and that's just because of valuations and what people are willing to pay for earnings. And I think the earnings story seems to be there. Earnings continue to grow, like you said, not just for tech, but for the broader market. Earnings estimates have continued to go up, yet the valuation is what's causing the market to be flat. They're sort of offsetting each other right now.
Did Salesforce make a new 52-week low? I saw Salesforce, as I'm scrolling through the ranking of top to bottom in the S&P. I think it did, didn't it?
It did. Yep. Just yesterday. Bounced off of it today, but it was at, 330 a year ago. It closed at 189 today.
I mean, its all-time high was what, 369 in December. December of 24. Yeah. Well, I mean, software sold off. So Salesforce is interesting because I wonder if there's switching costs for companies. And we actually don't use Salesforce. I've used Salesforce in the past, but you think I have all this CRM data, I have all this history of notes and everything. And if I switch, then how do I guess you can transfer that stuff, but I feel like, is that just the AI thing that's going on there? People are like, oh, somebody's just going to code something that's totally cheaper and better, and you don't need the Salesforce anymore, I guess.
That's how I read that. I mean, you look at a stock like Adobe too. They have almost identical charts. I think it's just
look at Adobe.
AI replacement. Do you really, in 5 years or even in a year, you can do almost anything you can do on Adobe and with AI. So
you're saying create graphics and things like that?
Yeah, exactly.
What was their, you know what? I got to broaden out the chart. I'm trying to see when their all-time high was. Oh, wow. They were 638.25, and they are 251.10 right now. Yeah, that's been. But also, look at Microsoft. Microsoft was down again today. It is now trading where it was in April, so it makes an unbelievable run. But it's also where it was, August of 24 and February 24. So this thing's kind of round tripped again. 555.45 down to 401. That's a bear market territory for a stock.
Yeah, so with Microsoft, is that because they're involved in AI? Is that just their CapEx is sort of exceeding what investors are willing to put their money towards, or how do you take that sell off?
No, I think this is a trade on OpenAI as a company, because they have the investment in OpenAI. There's an embedded sort of warrant or option with Microsoft. So if OpenAI was trading publicly, and we have no idea what their financials are, we've heard kind of renderings or talk about how they don't make money and they do it, their sales and things like that, but it's not public. I think if OpenAI was public right now, it would be down 50%. Because I'm not saying it's a good or a bad company. It's not public. I have no insight into it. I'm just saying, just because they're one of the players right now, it doesn't mean they're going to win. And I always go back to the browsers: Netscape, Excite, Spyglass, Yahoo, Google. Of those, who's left today? It's Google. So, that's the kind of way I look at that. Is it Claude? Is it Anthropic? Is it Gemini? I don't think anybody knows, but it's the embedded option. It's got to be.
Right. That makes sense. Yeah, because we did see that rotation from Microsoft and sort of the OpenAI rally mid part of the year towards, October or so, and we saw a flip towards Google. And Google became the top dog. Now Google is also sold off, from a high of 350 down to 306 today, but we did see that flip, and Microsoft certainly was leading the way lower when that happened.
All right, let's talk about gold a little bit. Gold, maybe silver. Gold is obviously pulled back from its parabolic high. It's still, if you draw a line like the 50-day moving average, it's still trading stretched above the 50-day. It's closer to the uptrend, uptrending channel line. Now that gold is pulled back, is it like, okay, now the adults in the room can invest and trade gold? Like, do you think some of the tourists were shaken out?
It seems that way. It's sort of encouraging how it's settled in here. It's still fairly volatile, but it's sort of settled in a range here. We're not seeing it free fall. It did, drop quite a bit for 3 days, but it does seem like it's shaken some investors out who are probably more short-term speculative rather than long-term believers in gold. And it seems like maybe it's basing here.
When I look at gold, and I got to tell you, I actually talked to some people who tried to sell like gold coins or gold bars, and they were really surprised how little they were offered for them, meaning that the dealers or whoever it is, the store they brought it to, was like, okay, yeah, the price of gold is here, but I'm going to buy it at a discount from you because I want to resell it. I was sort of reminded, like, GLD is so easy to buy and sell. Like, if you wanted to buy or sell gold, I get it. You don't have physical gold, and you could say, okay, maybe I want physical gold in case everything goes to hell in a handbasket. I'd argue you'd be better off with cans of beans at that point. But like, GLD is so easy to trade, and there's probably other vehicles, but that was the original one. So, I kind of think the adults are in the room now.
Yeah, no, I agree. I know a lot of people like to own the physical gold. I don't understand why you wouldn't just own GLD. It's so much easier, and you're getting the price where it's at that point in time. You go to some shops, and think about the risk that these guys are taking buying it from you, right? With how much it's fluctuating. So they have to buy it at a discount with all the volatility. I think I think some states have laws where, if you take it to like a pawn shop, they can't sell it immediately. Like, they have to hold on to it for a certain amount of time to make sure it's not stolen or something. And so, you got to wait 30 days before you can sell it. There's no way you can just pay spot for it and assume it's going to move higher.
You and I would say, if not like you and I are thinking about opening up a pawn shop or a gold dealership, but I'd be like, okay, I can hedge this.
Sure.
But there's a cost to hedging.
Right.
It's kind of what market makers do when somebody buys or sells an option and the market makers are making a market. The more volatile the underlying asset is, the more premium that's in those options, and the higher the cost to hedge. So
that's right. So probably the bigger the discount you're going to get when you're trying to sell physical gold.
Yeah, no, I think that's right. Silver is, look, I don't pretend to follow silver. I kind of follow it when it's in the news. I follow gold more. You look at that chart, it looks like something that went parabolic and is coming back down. Like, I don't know where it's going to go from here. But silver historically has had these periods where it really goes and then it kind of doesn't do much for a while. So I can't really say what's going to happen with silver. I don't remember all those ETFs we covered the one day with all the other metals, palladium and platinum and, Freeport McMoran, FCX, that's still up, right? That's a copper company. So copper, it seems like, is still doing okay. The other thing, so going back to you brought up some of the sectors that are all making 52-week highs. Like, if this was a bad market, that wouldn't happen. If this is a really below the surface, like if you were to say this market's really bad, you wouldn't have all those sectors making 52-week highs.
That's right. Yeah, we're not seemingly in a market where companies are struggling to find profits or earnings. Like there are companies doing very well. It is just it's different than what I think we've seen the past few years. Seeing some of these sectors lead the way, but it's encouraging to see the market broaden out in this way. Yeah, I agree. You can't say we're in a bad market with those six sectors hitting 52-week highs all this week.
I mean, you got to think not only value managers, but managers who are picking individual stocks and, taking things, not just trading the indexes. They have to be like, I told you.
Finally.
I told you. Finally, right?
Right.
If they have the right stuff. Maybe they're overweight Microsoft and underweight Apple. Like, that wouldn't be good. They would have gotten that one wrong. But yeah, I mean, sometimes the stuff that's unloved, it was right there all along for somebody to pick up off the floor. It was a Jim Rogers used to say when trading, sometimes he walks into a room, there's nothing in the corner. He walks in again, there's nothing. He goes in again, and there's a dollar bill sitting in the corner on the floor, and he goes over and picks it up. Like, his point was, sometimes stuff gets cheap enough, and if the fundamentals are okay, like, you go over and pick it up. And it seems like a lot of the stuff in the market was cheap enough. I mean, really, it doesn't seem like it's an earnings problem right now. It's now just trading around the valuations. Like, this is all, what's the forward PE or lack thereof on all these things. And the earnings story hasn't changed, but people are willing to pay less for some things, and they're willing to improve their PE on other things. And that's really what's going on right now in the markets.
Yeah, I mean, and it's not even just the U.S. International stocks. If you look at EFA, they hit highs this week. Emerging markets hit highs this week. So, globally, markets are also doing well. Those are also two. If you have a diversified portfolio, for years you're like, why am I owning international developed markets? And now it's paying off.
I mean, that's been a widowmaker for years, meaning like, oh yeah, you have to own some diversified global stocks. You have to own emerging markets. You have to own a little bit of developed foreign frontier markets. And it's like, no. S&P was where it's at. No, I mean, in 25 and so far in 26, those trades have continued to work. We're continuing to see outperformance, especially on the Mag 7. And so what changes this for the Mag 7? Is it Nvidia's earnings? When do they report? The 25th, I think, right?
It is.
I'm just looking at the volatility chain as you're doing that because I want to see where the implieds are.
Yeah, the 25th.
Okay. So if I look right now, implied volatility on the 27th expiration of February options at the money is about a 57% implied volatility. So, if I look at some of the other tenors, if I say, let's go out to March and I look at that same thing, what's the difference? And the difference is, well, they don't have an earnings report. Yeah, it's not elevated yet. So when I say not elevated, it's like 57 IV versus a 49 IV for the expiration that's a little bit past that. But what has to happen for the Mag 7 to do its thing again? Is it Nvidia just blowing out earnings?
I don't even know if it's blowing out earnings as much as it is, the rhetoric on the call and, encouraging investors to pay a higher multiple. I think, by all accounts, earnings are probably going to be at least okay. A miss would be horrific, but just assuming earnings are okay, or tick up, that doesn't necessarily mean that depending on what they say on the call, that it's going to drive the stock higher based on what we've seen this year with the multiples coming in. We could see earnings tick up, and if the call is just sort of the same, I don't see a reason why this would move higher.
Well, I mean, I guess it goes higher if if the story is still intact, if we're in the fifth inning instead of the eighth inning of the AI build out and the AI story. I mean, that's really what it is.
Sure.
But to your point, I mean, what did I say their forward PE was?
26,
right? Okay. So if you think about Nvidia and you kind of look at and you say, okay, if I multiple re-rate from a 26 down to a 22 or 21 or a 20, like that's material. So you could see the stock report good earnings, good forward estimates, maybe even the estimates go up, but you have a multiple compression and you can see the stock go down. You can see the stock go up too. Like they've grown into their multiple for sure. Like because the earnings, not only the actual earnings, but then the forward earnings have continued to go up. So, well, what do we say though, Mike? Nvidia is always the most important earnings report ever until it comes out and you're like, okay, nothing really too much there.
It's the island effect. They're all alone, and so we're always focused on it because there are no other earnings around them.
No, that's right. I mean, really early you get Taiwan Semiconductor, and Taiwan Semi makes all the stuff for Nvidia, I believe. So that's the early tell, and I think Taiwan Semi's earnings were pretty good. So
yeah,
somebody out there can do that analysis. Look at, has there been a time where Taiwan Semi has reported really good earnings and Nvidia has not reported good earnings? But
that would be interesting to see.
Not something you or I are going to do, but somebody can do that and send it to me. You can send it to me at derek.moore at zegainvestments.com. That's derek.moore at Z as in zebra, E as in Annie, G as in George, A as in Apple. You're going to have to, you're on your own spelling investments. You can get a hold of me. All right. Do we want to talk about bond yields at all? Like bond yields, I feel like coming into the year, everybody thought 10-year yields were going closer to 5, not closer to 4, and certainly not having a 3 handle again. I mean, I don't know. Do we see 3.9 on the 10-year now, given this inflation print?
Yeah, I mean, again, it's 1 month. I think if we consistently see this moving forward, I think we're going to get the 3 cuts. I think we could see that.
And we know that they really control the front end, not the back end, but 4.048 10-year yield. It was 4.6 rounded May 21st of this year. So
it was 4.6 May 21st, you said?
Yeah, I think so.
Yeah.
I think so. And, the 5, it was almost 5 in October of 23.
Okay.
So, if you look at a long, like a 5-year chart, it's been trading, in a little bit of a range for a while, not necessarily going down. It's got some support below it. If you treat this like a stock, if you treat the yield chart like a stock chart. So, yeah, I mean, if inflation's pretty benign, do we see a 3.5% 10-year? Why not? Sure. I'll let you know when I know.
Yeah, I'm with you there. I don't have a ton to say about it other than I could see that if inflation keeps coming in the way it came in today.
This is also a really interesting market because not everything is acting the same. Like these are fun markets to be a watcher of and a participant in, because it's kind of cool. It's like, oh, this stock is doing this one's not doing that, as opposed to just everything going up. This is different than we saw in 25. This is really different.
It is different. Not only sectors in the S&P, but just looking at, small cap stocks. Of course, those are up today with the good CPI number. Looking at international markets, it's a very different market than the tech-driven market that we've seen the last few years.
Yeah, I mean, you look at SPX was actually flat today. The RUT was up 1.18%. So, and those are very rate-sensitive stocks, I would say, because their borrowing cost, it's tougher for them to get capital. Their borrowing costs, sometimes they do floating loans. They don't have the same lines of credit or debt available instruments to them that an Apple would. So, and a lot of those companies have debt, and so if you reduce your cost of debt, your interest cost, then your margins go up. So these they're very very much sensitive to changes in rates. So, all right.
One interesting earnings report today. Not a stock that I follow too much or product I'm too familiar with, but Pinterest reported earnings. Okay. And I want to get your take on this because it's something that they said on their call. The stock went down like 15% today.
What's the symbol on Pinterest, by the way?
PINS.
Okay. Not one I follow either, obviously.
Yeah, the stock's down a ton. It was at 40 back in August. It's trading at 15 and change today. But on their earnings call, they basically said that tariffs have caused advertisers to pull back on advertising spend. Sort of one of the few times I think I've heard companies really blame tariffs for poor earnings results. Do you take any stock in that? Or is this sort of a one-off case where maybe this company is just operationally broken and they're not getting the eyeballs they need to draw advertisers?
I can't say I know a lot about who is going there, whether the fad of Pinterest has shifted. I think I look at the Target Walmart comparison and look at those charts, and you would say, well, they kind of do the same thing. They don't necessarily, because I think Walmart is much better at e-commerce, and they're more of a rival to Amazon than Target. I think I don't know a lot of people just go to Target and buy stuff. But I look at those two companies. So it's always kind of restaurant stocks. One restaurant stock will do good, and then the other one says the economy's bad, people can't afford stuff, and it's not you, it's me type deal, right?
Right.
So I don't have a lot of insight into pins.
That's kind of how I took it. Was they're in online advertising, which I haven't heard Google mention that people are pulling back because
it would be Meta or Google who would probably mention that.
Right.
I would take it from them more than I would take it from Pinterest. I just don't know.
Yeah.
I don't know who's going to Pinterest.
I thought it was interesting that they mentioned it, and it just sort of seems like we had bad earnings. We need a reason. So
when they say bad earnings, though, it was 67 cents. And then I look at the prior reports, 38. Is that the dividend or the earnings? No, I think that's the earnings, right? Yeah. So I'm looking at like those earnings. I'm looking at the Thinkorswim chart, Mike, where we have the earnings and the dividend icons there. So maybe they said something in the forward forecast.
That must be it.
I don't know. I mean, does your wife go to Pinterest? I never hear mine talking about Pinterest.
She does occasionally.
Okay.
It was weak. So it says a fourth quarter earnings miss and weak guidance.
I mean, maybe people don't they make money from advertisers like having their product and then getting a referral link that Pinterest would earn? Because I think Facebook does that or Instagram does that. So maybe Instagram is just much better at it and people are just there. Or TikTok right. And Instagram. I don't know. All right. Speaking of, actually, there's no transition there. Any recommendations this week, Mike?
Yes. This is a strong buy.
Oh, I'm excited.
If you're a Game of Thrones fan, A Knight of the Seven Kingdoms, fourth episode just came out. 30 minutes each, so they're pretty short, but very good. And the fourth episode, it really, really picks up. So it's a strong buy.
Is this the same people or same writers who did Game of Thrones?
Same writer, yep.
Okay.
The main character, he's sort of like average guy in the Game of Thrones world. It takes place 100 years before Game of Thrones. The main character is just sort of your average knight, and they're sort of just following him around, and he's kind of like the Forrest Gump of Game of Thrones so far. He's finding himself in these situations I don't think he ever thought he would.
Oh, I just looked it up. Okay, so it's on HBO.
Yep.
So that would make sense since Game of Thrones was on HBO. All right. Strong buy, though. That's aggressive right there.
It's very good.
Okay. All right. I'll have to put that on my list. I have The Lincoln Lawyer, season 4. Watch that. And unlike Hulu and HBO Max, who refuse to just give me all the episodes at once of a show, they dump them all. Thank you, Netflix, for doing what you do. And I thought it was good. Lincoln Lawyer. There was the movie. There's now 4 seasons of the show, and didn't disappoint. So I'll put a strong buy on Lincoln Lawyer too.
Okay,
so 2 strong buys this week, and I'm sticking with my prior on what was my one last week. I had a sell on Landman, and then I went to just a buy, not a strong buy.
You're still at a buy.
I'm still at a buy there. I've thought about it more. I think I'm a buy. I'm a hold on season 1. I'm a buy on season 2.
Okay.
How's that? All right. We did it. We got to the end. Mike, thanks for joining me again. Shane will be back next week. For everybody else, we'll talk to you soon. Have a good weekend.